Every major economic collapse I have studied long enough to respect had one feature in common. The people who built the largest fortunes out of it did not start moving after the crash. They moved before it. That is the part the public almost never hears clearly, because the public is given a story designed to make ordinary participation tolerable, not a story designed to explain how very large money actually behaves when the cycle begins turning against the crowd. The public is told crashes are random. It is told diversification is enough. It is told that trying to prepare is arrogance, that waiting is wisdom, that timing is foolish, that patience means staying exactly where you already are. That advice is not always wrong. It is just not the whole truth. It is a decent operating manual for people who will never control enough capital to reposition aggressively without moving their own life off course. It is not the manual serious money uses when credit is tightening, liquidity is thinning, valuations are stretched, and the first signs of stress are showing up in places ordinary people were never taught to watch. I want to be very clear about this. The wealthy do not prepare for a crash by predicting the headline. They prepare for it by collecting assets that become more powerful when everybody else is suddenly forced into bad decisions. That is the whole playbook. And if you understand that sentence, you already understand more than most of the people who spend every day reading market news but still somehow never seem to see the crisis until the damage has already arrived in their own account. A crash is not only destruction, a crash is a transfer. That is the phrase I want you to hold in your mind while we go through this. Because the middle class is usually taught to experience recessions and crashes as things that happen to it. Jobs get weaker, accounts go down, credit tightens, life gets harder. The wealthy, or at least the people who think like the wealthy, experience the same event differently. Not pleasantly, not painlessly, but structurally. They see a future inventory event. They see forced selling, they see distressed owners, they see good assets in weak hands, they see time pressure, they see solvency pressure, they see legal priority, they see scarcity, they see what the world must still buy, even when confidence is gone. That is why they begin moving 18 months before the public knows what phase the cycle is in. Not because they are magicians, because the same late cycle signals appear over and over again, generation after generation, under different names. Credit expands too far. Rates stay easy too long. Asset prices drift away from arithmetic. People call leverage normal. The culture starts confusing rising prices with skill. Then the first cracks appear, and the people who know what those cracks mean stop asking which asset will perform next quarter. They ask a much better question. What do I want to own when other people no longer have the luxury of choosing? That question is worth more than most graduate finance degrees. Because once you ask it honestly, the list of assets becomes much shorter, much stranger, and much more revealing. The first asset sounds so boring that most people immediately assume it cannot possibly be the right answer. That is precisely one reason it works. Short duration government paper, treasury bills, cash equivalents, 90-day sovereign instruments. The sort of thing ordinary investors mock when markets are rising because it looks timid and unimaginative, and, worst of all, it does not produce a dramatic story. I have always liked assets that do not need a dramatic story. Dramatic stories are usually what people buy when they are already too late. Cash is different. Cash is not there to impress anyone. Cash is there to preserve optionality. And optionality is one of the rarest and most beautiful forms of power in finance. If you hold $10 million in liquid short duration paper, while everybody else is fully extended in inflated assets, you may look foolish to people who measure intelligence by how aggressively someone chased the last phase of the boom. Then the crash begins. The SP loses half its value, private assets get marked down late, and then viciously, commercial real estate freezes. Good businesses trade at stupid prices because their owners suddenly need liquidity more than they need dignity. And the person sitting in short government paper stops looking timid. He starts looking armed. That is what T-bills really are late in the cycle. Stored buying power, ammunition, dry powder, call it whatever phrase you like. The mechanism is the same. Crashes require sellers. Sellers require buyers. Buyers require liquid money that was not destroyed by the event itself. That is why I always smile when people say cash costs you yield. In late cycle markets, cash does not cost yield. Cash buys freedom, the freedom not to sell, the freedom to wait, the freedom to buy from people who can no longer wait, the freedom to turn somebody else's emergency into your long-term opportunity. That is why Berkshire piled into T-bills in periods when the financial press was accusing it of losing courage. The public always confuses patience with fear right before patience becomes the most valuable trait in the room. Now let us move to the second asset, because this is where the architecture of modern wealth transfer becomes much harder to ignore. Once you see it clearly, distressed debt. This is the asset ordinary investors almost never understand in time, because the financial press teaches them to look at a collapsing company through the stock chart, not through the capital structure. That is one of the great blind spots in public investing. When a company begins failing, the public looks at the equity and sees ruin. Sophisticated money looks at the debt and sees legal priority. That is a very different way of reading the same event. If a bond issued at par begins trading at 20 cents on the dollar or 15 cents on the dollar, most people read that as a death sentence. Sometimes it is. Often it is something much more interesting, because bankruptcy is not merely a funeral. Bankruptcy is a transfer mechanism. And that mechanism is governed by priority. Senior lenders first, junior lenders next. Equity holders at the bottom, usually holding nothing but grief and hindsight by the time the process is over. That means the person who buys distressed debt is not merely betting that the company survives. He is often buying a claim on the assets and future ownership of the reorganized business without paying an equity price for it. That is why Howard Marks built so much of his fortune where he did. It was never really about predicting miraculous corporate comebacks. It was about understanding that a company with assets, customers, contracts, property, infrastructure, roots, brand value, or industrial usefulness may be mispriced, not because the assets are worthless, but because the current owners are trapped in the wrong part of the legal structure. That is what the public misses. The old shareholders are not always being punished because the company had no real value. They are being punished because they sat in the wrong claim position when the music stopped. Distressed debt lets you sit higher in the waterfall, and when the waterfall runs, position matters more than optimism. Look at any major bankruptcy wave. Retail investors are wiped. The headlines say a company died. The sophisticated buyer steps in earlier than the public notices, accumulates paper at distress levels, and then emerges from the proceedings holding equity in the reorganized entity, often at an effective cost basis that would have sounded absurd in normal conditions. That is not a market accident. That is legal architecture doing exactly what it was built to do. Now, I want to say something uncomfortable, because it is central to understanding crises honestly. Distressed debt requires distressed lives to exist. Corporate failures mean jobs lost, pensions impaired, savings destroyed, plans delayed, and whole communities destabilized. That is the raw material. The person buying the paper at pennies is not creating the damage, but he is using a system designed to convert other people's distress into future ownership. That is why I say crashes are transfers, because the assets themselves do not vanish. They move, factories move, routes move, brands move, malls move, warehouses move, cash flow streams move. They move from dispersed, hopeful hands into concentrated, patient hands through legal mechanisms most ordinary people never studied closely enough to respect. That is the second asset. The third is older than all of this, older than bonds, older than the stock market, older than central banking, productive agricultural land. Not symbolic land. Not empty dirt bought because somebody likes the romance of owning acres. Productive land, land that grows calories, land attached to export demand, land linked to permanent human need. The reason this asset has survived every monetary breakdown and every paper boom is primitive enough that modern finance keeps underestimating it. People have to eat. That sentence has more investment wisdom in it than half the jargon Wall Street produces in a year. Calories are not discretionary, and the land that can produce them carries a type of floor under its value that paper claims do not. The floor is not sentiment, it is biological necessity. That is why prime farmland behaves so differently from urban speculation and from so much of commercial real estate during severe dislocations. A downtown office tower needs tenants, financing conditions, and a healthy corporate ecosystem to justify its value. Prime farmland needs weather, labor, and the permanent fact that human beings still require food. That is a much sturdier dependency structure. This is why in country after country, productive land holds real value when paper systems start breaking trust. Roman elites understood it. German industrialists understood it during monetary chaos. Modern billionaires understand it. Now, even when the public insists on turning their land purchases into personality stories or cultural arguments, I do not care about their personalities. I care about the logic. If you can own scarce productive land tied to global demand, Then you hold an asset the central bank cannot print. A government cannot easily multiply, and a currency collapse cannot erase in the same way it erases paper balances. That matters enormously. And there is a second edge here that most people miss. Not all farmland is equal. The best farmland is not merely a local food story. It is a claim on enduring demand that may even be global and dollar-linked while the local currency and local financial system are under stress. That is what turns land from a rural romance into a serious institutional asset. Now let us move to the fourth asset, because this is the one many people pretend to dismiss until they are wealthy enough to need it. Blue chip fine art, not decorative art. Not things people buy because they match a couch. I mean, works with institutional provenance, recognized market depth, finite supply, and serious collector demand. People like to laugh at this category because it sounds elitist and theatrical. Sometimes it is. But that does not make the financial logic fake. Art at the high end possesses two features that over-indebted monetary systems have always forced sophisticated wealth to appreciate more deeply than the public does. First, supply is absolutely fixed. Not fixed by policy, not fixed by a production quota, fixed by death and scarcity. The artist is no longer creating. The works are finite. When money supply expands aggressively, while the supply of a globally recognized cultural asset remains frozen, the relative appeal of that asset changes whether people like the sociology of it or not. Second, high-end art can trade privately. That matters. Public markets are transparent. Public prices are visible. Public panic becomes public markdown. Private treaty transactions move differently. A pressured seller may need liquidity. A buyer with patience and access may get the work at a price that never becomes a headline or an index entry. The opacity is not an accident. It is one of the reasons serious wealth uses the category at all. When private sales spike before stress events, that is not because billionaires suddenly become more tasteful all at once. It is because they are rotating into scarcity that sits outside the conventional financial system and is much less correlated to the daily emotional swings of equity markets. Is art necessary for ordinary people? No, that is not the point. The point is what it teaches. It teaches that the wealthy are willing to hold assets the public calls eccentric if those assets preserve purchasing power through a regime shift. That is a useful lesson, even if you never buy a painting. There is another reason I want you to understand this category. Even if you never participate in it directly, it shows you how different the wealthy investor's objective really is. The public is usually taught to maximize visible return inside standard channels. The wealthy are often trying to preserve optionality, scarcity exposure, and purchasing power outside those same channels. The public asks, what performed best last year? The wealthy ask, what cannot be manufactured, diluted, or broadly dumped into by the crowd in the same way everything else can? Those are very different questions, and they produce very different portfolios before the world becomes difficult. Now we come to the fifth asset. This is the one that matters most because the first four can be understood as defense. They preserve, they position, they protect. The fifth is offense. The fifth is where entirely new fortunes are built after the crash starts doing its work. Essential service monopoly businesses. This is the least glamorous phrase in the entire conversation, which is one reason it tends to be the most profitable. Waste collection, self-storage, funeral services, water infrastructure, pest control, medical waste handling, boring things, beautifully boring things. The public does not get excited about them in good times because they offer no fantasy, no disruption myth, no social prestige, no dream of exponential global transformation that lets someone feel visionary at a dinner party. They simply serve needs that do not disappear when GDP gets sick. And that is precisely why they become so powerful in downturns. People still produce garbage in recessions. They still need somewhere to put their belongings when they downsize. They still die. They still need clean water. Hospitals still need regulated disposal. Roaches do not stop breeding because the central bank changed its tone. This is what makes these businesses extraordinary. Their revenue is linked to life rather than mood. That gives them resilience. But resilience is only half the story. The other half is consolidation. When a downturn hits, small operators in these industries often get squeezed. Leverage that looked manageable in a good economy stops looking manageable in a tighter one. Refinancing becomes difficult. Margins vanish. Liquidity disappears. Capitalized buyer arrives and purchases routes, equipment, contracts, customer lists, and local market share at prices that have very little to do with long-term intrinsic worth. That is how fortunes get built, not by buying the glamorous asset at the top, by owning the dull essential business when weaker owners are forced to sell it. Wayne Huizenga did not build waste management by winning a storytelling contest. He built it by understanding that garbage routes are better businesses than glamorous narratives when the cycle turns and consolidation becomes available at distressed prices. That is one of the oldest truths in capitalism. The biggest money is often made in the sectors the culture least respects. That is because the culture usually pays attention to fantasy and growth, while serious money pays attention to cash flow, necessity, and market structure. Now let me say the thing that ordinary investors always need to hear at this point. You may not have access to every exact vehicle the ultra-wealthy use. You may never buy distressed paper directly out of a bankruptcy process. You may never acquire thousands of acres of prime land. You may never transact privately in fine art. You may never buy a regional storage operator from a panicked local owner during a credit crunch. That is fine. The power of this framework is not that you must mimic every institutional expression of it. The power is that you can borrow the principles. You can hold more liquidity when the cycle gets stretched, instead of believing cash is always stupid. You can learn to value boring essential businesses more highly than the culture does. You can stop treating every downturn as random weather and start treating it as a period where good assets move from weak balance sheets to strong ones. You can stop confusing ordinary public narratives with the actual operating manual serious capital uses. That alone changes your results, because most people are not ruined by lack of access. They are ruined by bad framing. They think the only choices are panic, passivity, or reckless prediction. There is another choice. Preparation, structured, unemotional, principles-based preparation. That is what the wealthy have always done. Now, let me pull the whole thing together. Short-duration government paper is ammunition. Distressed debt is legal priority turned into future ownership. Productive farmland is a caloric claim on permanent human need. Blue-chip art is scarce, private, and outside the usual paper channels. Essential service monopolies are where new fortunes are made because they keep earning while everything around them weakens, and then absorb weaker competitors at crisis prices. That is the list. But the deeper lesson is larger than the list. Every crash is a shopping event for people who spent the prior 2 years deciding what they want to own when others no longer have the luxury of choosing. That is the playbook. The middle class is usually taught to improvise after the panic begins. The wealthy prepare before the panic becomes socially acceptable to believe in. That is the real divide. They do not necessarily know the exact date. They do not need to. They know the shape. They know the sequence. They know what gets sold first. They know what survives. They know what becomes available only when somebody else's solvency has already run out. That is why I say the most important thing is not the asset name. It is the principle. Cash is not cowardice. Cash is conversion power. Boring businesses are not inferior. They are often the only businesses that still look intelligent when easy money leaves. Hard assets tied to permanent demand matter more than fashionable culture. Admits, legal priority matters more than public optimism. Scarcity outside the paper system matters more than smooth narratives during a monetary regime shift. And if you can understand those principles, then you stop being the kind of investor to whom crashes merely happen. You become the kind of investor who sees the shadow of the crash in advance and starts standing where the transfer will favor him instead of where it will consume him. That is the whole point. Not fear, position, not prophecy, preparation. And that is why the right question is never, when exactly will the crash begin? The right question is, where do I want to be standing before it does? That question built more dynasties than intelligence ever did, because intelligence without structure panics. Structure without brilliance still wins. And the people who keep winning across generations are usually the ones who understood that difference, while everybody else was still repeating the safe story that crashes are random, and there is nothing useful to do before they arrive. There is always something useful to do. The wealthy have been doing it for more than a century. The only real question is whether you are willing to look at what they actually do instead of what the public story keeps